Hello, I am Rick Steele, CEO of Loftus Peak. Welcome to UpdatePlus, a short tour around the grounds of investment in the big disruptive trends that are driving business. The apparent consensus among commentators in Australia has been that an upcoming global recession will drive company earnings lower and in turn send world share markets lower. While this outcome remains a risk for the broader market, in apparent defiance of that risk, of late there has been a strong, narrow rally in the companies seen as driving disruption globally, particularly companies associated with artificial intelligence. The question that these same commentators are asking is, why is it so? Why are some share prices rising despite higher interest rates that are now in place, above 5% in the US from almost zero a year ago, and slowing global growth? Yes, central banks around the world have increased short-term interest rates quickly and sharply to address inflation, and this is impacting both consumer and business behaviour. Of course, that's the whole point of tighter monetary policy, to slow down demand and reduce inflationary pressures. This now seems to be working, suggesting a peak in short-term interest rates may not be too far away. Share markets, of course, are driven by expectations and look to the future impact on company earnings of the evolving macro backdrop. This was evident in 2022 when world share markets declined over 18%, anticipating the likely impact on company earnings as interest rates rose. We saw value emerge in many disruption names in this period, and so reduced cash and added to existing and some new names. In the year 2023 to end of May, global share markets have now risen almost 8%. Over the same period, many companies that are driving disruption globally have risen strongly. Many semiconductor companies have shown exceptional share price moves. Nvidia has risen 159%, Advanced Micro Devices 83%, and Marvell Technology 58%, to name just a few. We've designed our funds management firm to manage portfolios in the world of disruption, the one we're living through right now, and that we expect to be living through for some time. Those who know us well will recall that we've been saying for some years that the current wave of disruption will begin with the tools of disruption, semiconductors, that are amongst the things enabling artificial intelligence. The chips designed and produced by semiconductor companies are required for the enabling platforms such as Amazon Web Services, Google Cloud, and Microsoft's Azure, that in turn provide new and emerging companies the ability to adopt capabilities such as artificial intelligence. Building a portfolio is more than just picking high-growth companies. Once we've determined a company's disruption credentials, we then apply a strict valuation process that attaches a risk ranking to each prospective company. When assigning this risk ranking, we consider a company's growth profile over the coming 3 to 5 years, its overall financial strength, balance sheet and cash flows, business plan execution risk, ESG risk, and other risks besides. Typically, adjusting for risk in this way results in assigning higher weights to companies for which we have greatest conviction, not necessarily the greatest upside. We understand that taking a 3 to 5 year view can mean having to withstand periods of volatility, such as we've seen in recent years, in order to participate in the eventual gain. However, when we look through the noise of financial markets, what we see today is the continuation of the forces of disruption that have been in place for some years and that we expect to continue for some years to come. Disruption is all around us and it's showing no signs of abating. Our job at Loftus Peak is to identify the likely beneficiaries of disruption ahead of time and position their clients for the coming 3 to 5 years, to be at the forefront of these major disruptive changes as they evolve. This is Rick Steele, CEO of Loftus Peak. Thank you for watching UpdatePlus.